A rocky road for Carvana as it misses estimates in its latest quarter. Retail units sold decreased for the first time in the company's history, with expectations of a sequential reduction in the first quarter of 2023 as well. The shares are down some 13%. Really, a lot of the concern now around this company, Jared, has to do with its cash position and its debt, because it's got rising interest payments over the next 3 months, and its sales are not going in the right direction.
Yes, and guess what? A lot of these companies, we're talking about interest rates and the Federal Reserve. Just to back up for a second, a lot of loans and term facilities are based on short-term interest rates plus a spread. Now, I don't know about Carvana's particular position with respect to that borrowing, but as interest rates rise, that burden gets heavier and heavier for the company. Let's go to the Wi-Fi Interactive. I just want to show our earnings heat map. Now, the big numbers are year-to-date. The smaller ones are what's happening pre-market here. I got to go to an equal weighting for Carvana. It's up 112% year to date, but it's down 13% overnight.
And look at the one-year chart.
Yes, well, and let's take a look at a two-year chart as well. It's down 91%, even more over the last 2 years. This is a company that is in trouble. I mean, just reading some of the analyst notes, here's Piper Sandler, overweight, saying on the company, let me make sure this is the right one. Yeah, says on the net higher debt, company is the best performing stock in coverage this year, and he's relatively happy with the recent trends. Management sounds, quote, convinced that additional capital won't be necessary. Right. I don't have that conviction.
Yeah, I mean, they talked about it a little bit on the call last night that they didn't think they would need to raise more capital. They've got $1 billion. They've got $8 billion in debt, this company. I thought analyst Zachary Fadem over at Wells Fargo was interesting. He said the results held no surprises. Share losses are, quote, poised to widen. But he says the share losses are self-inflicted because of inventory cuts, staffing, and ad spend.
Yeah, and then you had that acquisition that they consummated in the second quarter of last year. You can't be a Swiss Army knife for everything with that kind of balance sheet in a high growth, transition from high growth to rising interest rates.
I mean, by the way, what Ernie Garcia, the chairman and CEO of the company, said, there's the opening bell on the call, we've got a real shot at not requiring additional capital. That to me doesn't sound like we definitely don't need more capital, right? That says we've got a real shot.
It's very aspirational.
Yeah, that's a good word for it.